Hello, I'm Quatran, Operations Manager of Proformative, the leading online resource for the Office of the CFO. I'd like to welcome everyone to today's event entitled How the New Revenue Recognition Guidelines Impact Budgeting and Planning. I'd like to thank our sponsor, Host Analytics, whose solutions help companies address the revenue recognition changes, and their commitment to thought leadership in this realm helps us make today's webinars possible and delivered at no cost to the participants. And listed in front of you are the learning objectives of today's webinar. I won't go through them, but they are on the screen for your reference. New rules governing revenue recognition for contracts will go into effect for most companies in 2018. Companies that use even moderately complex contracts in their dealings with customers will find that in addition to changes in an organization's contracting and accounting, also will need to examine their planning and budgeting process. So today's webinar will discuss if your company will need to make the changes to its planning and budgeting processes when the new rules go into effect and more. And before we welcome our speakers today, there are just a few event notes I'd like to go over with everyone. The slide deck that we currently are broadcasting here is already available for your download. It's under the handout section in your GoToWebinar control panel. You may have to just click the blue flower icon on your taskbar to bring the control panel to the front. Then you might have to click that plus sign next to handouts to expand the download. Additionally, we'll be sending you links via email to the presentation and the recording within 24 hours after today's event. For those who are seeking credit for the hour, please remain on the line for the entire duration and answer all polling questions. There is a total of 3 polling questions throughout the webinar, so make sure you answer those. Credits are typically awarded within 24 hours. And if you have any questions at all, please email cpe@proformative.com. And our team will get back to you as soon as we can. And today's event is certainly an interactive one. We have 3 expert speakers on the line, and we can tap their expertise during the Q&A session that we have at the end of the event. And we're actually taking questions anytime throughout the event. You can use your question box under your GoToWebinar control panel. Once again, you just might have to click that plus sign to expand that box, and then feel free to type in your question at any time. And finally, we thank everybody in advance for staying on the line for a quick minute after today's event to take our short post-event survey. Proformative loves your feedback, so we welcome any and all comments, suggestions, any thoughts you might have. So thank you very much for that. And a quick word about Proformative's online learning platform. We have over 400 courses at the moment built by experts with over 20,000 years of experience. It's all available by streaming video 24/7 on any device you own. All the courses are accredited, engaging, and effective. So if you'd like to check out the catalog, please feel free to visit proformative.com/courses. Now let's get to introducing the speaker who is kicking us off. On the line is Robert Kugel, SVP and Research Director at Ventana Research. Rob heads up the CFO and business research focusing on the intersection of information technology with the finance organization and broader business applications. Rob was an institutional investor, All-American team member, and on the Wall Street Journal All-Star list. Rob has experience in aerospace and defense, banking, manufacturing and retail, and consumer services. So Rob, really good to have you on the line today. The floor is yours. Please take it away.
Thanks, Kwa. As you mentioned, new rules governing revenue recognition for contracts going into effect for most companies in 2018. The Financial Accounting Standards Board, what we call FASB, which administers U.S. GAAP, has issued ASC 606, and the International Accounting Standards Board, or IASB, which administers the International Financial Reporting Standards used in most other countries, has issued something called IFRS 15. In the interest of time, I'll speak only generally about the changes in accounting processes. On the whole, though, the 2 standards are very similar, and they're going to enforce fundamental changes in this area of accounting. The bookkeeping is a bit more complicated, and companies will need to pay close attention to the revenue recognition implications of how they structure and word their contracts. The change was intended to create a comprehensive approach to the revenue recognition process in order to converge existing standards, streamline what in the U.S. Had become an unwieldy process, and achieve international consistency. ASC 606 in particular was designed to shift to a more principles-based rather than a rules-based approach to revenue recognition. At the same time, the boards wanted to force as few changes as possible in revenue recognition patterns. And while I hope they've succeeded in achieving this objective for most companies, that's not going to be the case for all. And at this point, it pays to be cautious. And here's something else to think about. It's not just the accounting that needs attention. Your company needs to review the specific structure and wording of contracts to limit delays in revenue recognition and reduce the uncertainty of the timing of revenue recognition. One reason we're doing this webinar is that so far, software vendors, consultants, and accounting professionals have focused most of their attention on how the new rules are going to affect the accounting organization. There's been very little said about the impact that the rules are going to have on the financial planning and analysis group. This is probably because the new rules will affect core accounting processes for most companies that do business using contracts. And right from the start, I want to be clear that the new rules won't impact the FP&A organization of every company that does business with contracts. But for those that it does affect, I think it can really complicate things when it comes to planning and budgeting. And it can do so in situations where there's a high degree of variability in the timing of revenue recognition for similar contracts, or whether there's significant differences in the timing of revenue recognition for different types of contracts. So what about your company? What impact is it going to have? The new accounting rules will have little or no impact on your planning and budgeting if you don't use formal contracts in your sales process. Now, I have to say my inner auditor forces me to note that, strictly speaking, the new rules apply to contract-like arrangements even if no written contract exists. But I don't think that's really relevant to this discussion. Examples of businesses that don't use contracts would include retailers of consumer goods, such as apparel, groceries, appliances, or primarily cash-only businesses like a movie theater chain. And there won't be any impact on organizations where sales contracts are used, but they aren't a significant part of the revenues. And even in companies that use formal contracts, there probably is going to be a limited impact on planning and budgeting if those contracts are relatively simple. For example, contracts covering a sale and delivery of off-the-shelf physical goods from inventory, or those involving a basic annual subscription that usually doesn't change over the term of that subscription. For these companies, although accounting processes are going to change, planning and budgeting probably won't, almost certainly won't, because there'll be very little variability in the timing of revenue recognition relative to events such as signing the contract, shipping the product, or fulfilling a service agreement. Nonetheless, some companies will face challenges in how they do business planning and budgeting when new revenue recognition rules go into effect. So it's important for FP&A groups that will be affected to be sure they have the appropriate systems, processes, and training to handle the more difficult demands imposed by the new accounting rules. And those companies that may be affected need to be sure they've crafted their terms of sale and designed their contracts to achieve their desired business objectives under the new rules, such as ensuring that revenue recognition isn't unnecessarily deferred or minimizing accounting department workloads. And it would be great if these contracts are written in a way that maximizes the predictability of when revenues can be recognized. So let's drill down a bit on ASC 606, on some of the more significant details that can affect the timing of revenue recognition and its variability for companies that use even moderately complex contracts in their dealings with customers. These contracts include, for example, ones that are structured using tiered pricing or volume discounts, or ones that routinely involve modifications such as adding or dropping users, or that allow seasonal changes to those services. One of the big changes under U.S. GAAP compared to what's existed in the past is that industry-specific guidance is out, professional judgment on the part of the auditor is in, And that's good news if you're in the software business, but things are going to generally be more complicated for everybody else that uses contracts. And I think what this means is that your CFO, controller, and head of accounting need to be on the same page with your auditors starting right now. And it means, and I'm going to repeat myself about this point, it means that sales, legal, and finance have to be on the same page in possibly redrafting contracts and setting up a process for revising and reviewing terms and conditions of sales contracts, especially where they concern things like variable consideration. That's such as, volume discounts or performance bonuses and the like. And this is important because contracts that cover a bundle of goods and services are treated differently than under current U.S. GAAP. A performance obligation is a key term a key item in the new RevRec rules. And while it's similar to what we refer to as a deliverable or an element, it's not the same thing in 606. So if a promised good or service is both capable of being distinct, in other words, the buyer can benefit from the good or service either on its own or along with other resources readily available to the buyer, and the obligation is distinct within the contract, it's considered a performance obligation. So it's important to make sure that your contracts, as best they can, support how you want to account for things. And I think it's also important for the FP&A group to understand how the rules are going to affect the timing of revenue recognition so that they can accurately forecast and plan and budget the timing of revenue recognized from these contracts. And there's a fundamental conceptual change for RevRec triggers. It's now about the transfer of control. And control of an asset, whether it's a product or a service, refers to the buyer's ability to directly control the use of it and obtain substantially all of the remaining benefits from it. Importantly, this represents a fundamental shift from internally verified revenue recognition triggers to external customer-driven triggers. This last part, something that the software business has had to deal with for many years, but now it's everybody's turn to have some fun. In many, many cases, there's no practical difference between this and current revenue recognition triggers. In some cases, though, the phrase substantially all of the remaining benefits will make forecasting the timing of revenue recognition less certain and more variable. For example, if you ship some big piece of equipment that does everything that's in the contract, except that the software for monitoring maintenance of the equipment won't be available for 2 months, can you recognize revenue right away, or do you have to wait 2 months until you finally deliver that last little bit? Well, let me see. The machine works. The customer seems okay with it, but what does the contract say? Is the maintenance monitoring a separate performance obligation, or is it integral to the buyer's control of the machine itself? And what do you understand about your auditor's opinion on such matters? So it's better for your CFO to sort this out right now than having to argue the point later. And if recognition is delayed, how do you treat that in discussing actual versus plan for the month just ending? And if your reforecast shifts that deal out to the second month and then the work is completed in the current one, how are you going to handle that? It may be that that piece of equipment is a bit more than a rounding error for the corporation as a whole, but it makes a huge difference for the business unit's performance. Maybe it's showing a loss as a result of all of this, even though almost all the cash has been collected and the deal is cash flow positive. Now, bringing this back to what the new RevRec standards mean for FP&A, in almost all cases, you won't have to worry if the timing of how your company recognizes revenue doesn't change. On the other hand, if the timing of revenue recognition winds up being meaningfully longer in parts of the business or more variable than it is today, then the meaning of the actual numbers can be a bit murkier. It's likely that the FP&A group will need to track and explain timing differences between an accounting event and a business event or a real event. If recognition is delayed, how do you treat that in discussing actual versus plan for the month or quarter just ending? This is important because the management response to address a lower than expected business volume is different from those needed to address missed revenue recognition thresholds. And this is going to be especially important if the numbers are significant and if your company is publicly traded because relatively small changes in revenue usually have much larger impact on net income and earnings per share. If you want to isolate the revenue recognition timing differences in the form of non-GAAP presentation to investors and do so credibly, you're also going to need to provide an ongoing reconciliation each quarter that illustrates the positive and negative impacts of differences caused by revenue recognition timing. We should also note that along with the changes in revenue recognition, there's potentially greater complexity in how companies account for certain expenses. For instance, direct sales commissions for subscription services can be capitalized over the life of the contract, but not, say, compensation paid to district sales manager for incentive bonuses related to his area's performance. And if that district manager also carries a quota, it's necessary to account for his or her direct sales compensation separately from that indirect bonus. So what does this all mean for the FP&A group? Well, if you're doing your forecasting, planning, budgeting, and reviews in desktop spreadsheets today, I'm pretty sure you're going to find it's going to be harder, if not nearly impossible, to keep on top of the timing differences in a way that's accurate and timely. You need to be thinking about alternatives. But back to the essence of the challenge. With the change in accounting standards, the time lag between when a contract's signed, when products are delivered and services are performed, and when your company recognizes revenue from the contract may be more variable and less predictable than the past. Whereas in the past, your company may have recognized revenue at or shortly after the time the contract was fulfilled at date A, going forward, it may on average be at date B for some contracts and date C and D for others. Or it may just change depending on circumstances. And this is where things can get interesting for FP&A groups. In extreme cases, performance measured by financial accounting will diverge materially from the real economic performance of the organization. Consequently, executives, especially those leading publicly listed companies, are going to need to be able to look at the plans from both perspectives and to be able to distinguish between the two in assessing their company's performance. In companies where the timing of revenue recognition can diverge substantially from current methods, FP&A groups will need to be able to plan using models that incorporate financial and managerial accounting methods in parallel. Because the management implications are different, they'll need to be able to identify actual to planned variances caused by differences in contract values booked in a period and differences between the expected and actual timing of revenue recognized from contracts in that period. And as I've noted, the changes necessitate a review of an organization's contracting and accounting policies and processes with the objective of avoiding unnecessary delays in revenue recognition and making the timing of revenue recognition as predictable as possible. Those that currently use desktop spreadsheets for planning and budgeting should consider adopting dedicated planning and budgeting software in order to cope effectively with the increased complexity of planning in this new environment. In some companies, this will create period-to-period variability in accounting revenue and expense that will make it difficult to measure performance to plans or budgets as they may exist today. So executives will need to sort out actual to plan variances caused purely by accounting events, such as failure to receive documentation to trigger recognition, and those that reflect real events, such as a shortfall in bookings or greater than anticipated labor hours. Some of the comparisons between real and GAAP amounts need to be measured period to period while simultaneously tracking cumulative differences both up and down on an ongoing basis. I've been working with spreadsheets for 36 years, so please take my advice. You don't want to be doing this in a spreadsheet. The main challenge for FP&A groups and companies affected by the new rules is having the ability to plan business events, for example, contract bookings and commission payments, in parallel with accounting events, for example, forecasting when deals are going to close and when revenue from them are going to be recognized. This would be a challenge if on a routine basis there are sufficient differences in the size and scope of contracts. This is often the case in engineering and construction, for example. Or if for any other reason it isn't possible to create an abstracted model that achieves a consistently useful, sufficiently granular approximation of the differences between real and accounting events. Very likely this will be more common than most people imagine. So while I don't want to exaggerate the planning and budgeting challenge, I also don't want to minimize it either. Entire corporations or business units with revenue responsibility will need to change their approaches to creating and using planning and budgeting models in order to accurately measure variances between their plans or budgets and their actual results. Companies that will need to plan and budget both real and accounting numbers in parallel will need to take a more granular approach to revenue modeling. In some cases, this will mean looking at individual large contracts and disaggregating them into performance obligations if necessary. In other cases, it will be a matter of combining types of contracts with similar revenue recognition patterns. And this means developing models that enable your organization to separate variances that are the result of differences caused by real business events that have occurred and those caused simply by timing differences. Certain types of businesses that have large, complex contracts with their customers, such as aerospace, construction, and engineering, are likely to find that in some cases they're going to need to plan, budget, and review results by contract, at least the 20% of their contracts that account for 80% of their revenues. Fortunately, some of them already have been doing this, but the methods might change because revenue recognition timing is going to be different. But I also want to point out that for many other companies, tracking individual contracts is going to be unnecessary, impractical, or both. It may be unnecessary because the relative size of contracts matters. Even if an organization's individual contracts differ significantly in terms of the interval between signing it and recognized revenue from the transaction, if there are enough of them, and even the largest represents a real insignificant percentage of total revenue, either for the company or whole or a business unit, that the difference isn't going to matter. That is, in most cases, the difference between expected and actual timing of revenue recognition of individual contracts is likely to be canceled out, one way or the other. Moreover, tracking individual contracts is going to be impractical for many organizations because their volume is going to make it too expensive and time-consuming to capture the relevant terms and conditions for each contract, which is necessary to be able to isolate the factors driving actual to forecast budget variances. For FP&A groups, the challenge is going to be in creating models that accurately forecast the average lag between contract signing and when revenue is recognized. Analysts also should confirm that the standard deviation of this lag under the new rules is going to be small enough to avoid the need to segment contracts into major types. And here's what I mean by that. Where there are significant differences between the timing of revenue recognition for different types of contracts, it's best to aggregate them as separate types for modeling purposes. So even where the value of each individual contract booked in a period is an insignificant percentage of the total, it may be necessary for organizations to segment contract bookings and revenues recognized for each major type of contract. And this would be the case if there are significant differences in the timing of revenue recognition between types of contracts, and the mix of contract types varies enough from one month to the next. For example, imagine that company X has contracts that have 3 distinct revenue recognition profiles. One of them, which accounts for a quarter of annual bookings, there's a consistent 1-month interval between when the contract is signed and when revenue is recognized. For a second type of contract, which let's say represents 40% of annual bookings, it can take up to several months before revenue can be recognized, and then it happens all at once. The remaining contracts are recognized over a year after a contract is signed. Now, any significant differences in the mix of contract types signed from month to month is going to make it difficult to reconcile variances and accurately identify differences caused by better than expected or inadequate contract bookings, and those caused by timing differences driven by differences in this mix. So it's necessary to create and use models that segment revenue by mix of contract types. To sum up, I think it's time for companies to get really serious about adapting their businesses to new revenue recognition rules. And, for the most part, they're gearing up now on the accounting side. They'll have to cut over to new process and systems in 2017, just a couple of months off, to comply with the new standards and be able to make year-on-year comparisons when new rules go into effect in 2018. FP&A groups should be considering whether their forecasting, planning, budgeting, and reporting models and processes are going to need to change under the new accounting rules. Those that will have to change should look into acquiring a dedicated planning and budgeting application if they or their affected business units are currently using spreadsheets for planning. And this will include many organizations. Our next generation business planning research finds that 2/3 of companies use spreadsheets to manage their budget process and generally their business planning processes. A dedicated planning application, budgeting application, is going to help them prepare better to understand whether a difference was due to the new accounting rules or poor performance using actual data rather than opinions. FP&A groups should be aware of their company's exposure to new revenue recognition rules. If the rules are going to have a material impact on how the company accounts for contracts, they should determine whether it will be necessary to plan and budget for real and accounting data in parallel. And if so, their company, if their company currently plans and budgets using desktop spreadsheets, I strongly recommend that they look into acquiring a dedicated planning application. In addition to dealing with increased complexity, this type of software can improve the budgeting and planning processes generally, making them much more effective and efficient at the same time. Unfortunately, the odds are that many companies affected by the new accounting rules are going to find it difficult to cope with it because they're using spreadsheets. Our benchmark research on next generation business planning finds that 2/3 or more companies use them to manage their budgets and other functions that can affect revenue recognition planning. Their planning models and data reside in desktop spreadsheets scattered across individual computers and file servers. In some cases, the information may also be in one or more applications. Manual putting together these individual strands in a spreadsheet on a regular basis is likely to be time-consuming and error-prone. While accomplished spreadsheet jockeys may be able to create a workable model at first, based on my experience, it's likely that they and the rest of the FP&A organization is going to find themselves working long hours, dealing with complex data imports, identifying period-to-period differences, and tracking cumulative variances, and having to check everything and tick and tie everything. Desktop spreadsheets are great for individuals who create planning models and work with limited sets of data, but they're not well suited for recurring collaborative enterprise processes like planning and budgeting. If you use them and you're affected by these new rules, you're going to quickly find yourself in Excel you-know-where. Our research shows that companies that use a dedicated application are more likely to have a process that works well or very well compared to those that use spreadsheets. A dedicated application is essential to support complex planning processes. Companies need software that facilitates access to all their business units' plans, simplifies collection of data, particularly from financial management systems, facilitates analysis and drilling down into detail, offers dashboards that are easy to create and modify, and supports automated and self-service reporting. This type of software can eliminate many of the barriers to more effective planning and budgeting, in addition to dealing with new revenue recognition standards. So we advise organizations to evaluate such projects as part of a comprehensive effort to improve all facets of business planning and budgeting, as well as preparing to deal with the new accounting rules. And now, Kwa, yes, I think we're ready to have our polling question.
Great. Thank you very much, Rob. Really great content. Let's take a minute here to launch our first polling question. And this one should pop up on a blue screen on your end. And it's asking, what is the primary software tool your company is using for budgeting and planning? And you can see your answer choices listed below the question there. Please take a quick second to lob in your thoughts. We certainly appreciate everybody's insights on this polling question here. And as a reminder to everybody, if you are here for credit, please make sure you answer all polling questions. This is the first of the 3 that we have. And another reminder is that we can take questions throughout the webinar at any time. Feel free to ask questions using the question box in your control panel. We're going to save the questions for the Q&A session that we have at the end. And I'll go ahead and leave this polling question up for another few seconds so that everybody can vote. And then let's shut it down and take a look at these results. So, John, the leading majority obviously is mostly Excel at 67%. What are your thoughts on this here?
Yeah, thanks, Kwa. Very consistent with what Rob just showed, actually. The middle of the pack, I think, in his research was around 70%, right? And it kind of went up from there and then down from there based on the types of planning processes, but very consistent. So it is consistent with what we see in the marketplace is high usage of Excel for a lot of budgeting and planning processes. And we do see the adoption of certainly cloud-based budgeting software is increasing, and the number here on the on-premises looks a little bit low. I think it's a little higher than that in the marketplace, but I think that's what a lot of companies are facing as they see the challenges with Excel, and they're looking for better solutions. So it's a good lead into next part of our session.
Okay, great. Thanks for your thoughts. And the voice you just heard belongs to John O'Rourke, who is the Vice President at Host Analytics. With a background in accounting and finance, John has over 30 years of experience in the software industry and over 16 years of experience in the EPM product marketing at Hyperion Solutions and Oracle. He has worked with many customers and partners on financial reporting and planning initiatives and has spoken and written on many topics in enterprise performance management. So John, good to have you here. Take it away.
Thanks, Kwa, and greetings, everyone. Thanks for joining us today. So in the next few minutes, I'll provide a quick look at the state of budgeting and planning today based on some other survey data, and then we'll transition to our customer case study and then take questions at the end. So feel free to keep keying those questions in during the session. We'll take as many as we can at the end. So let's get started. First, let's put budgeting and planning in the context of enterprise performance management, or EPM, as you can see here. EPM is a process and a system that helps organizations to link their strategies to their plans and their execution, and typically includes the following key processes. Starts some kind of business modeling before you start the budgeting process, which a lot of companies are doing now. Sometimes some high-level modeling, strategic planning might occur to maybe set some targets and key goals, and then those will flow into the annual budgeting process and the other planning activities. That's the next major step in the cycle. Annual budgets, workforce plans, CapEx plans, initiative plans, all the various plans and budgets that we put together. And then a lot of organizations now are updating those plans on a regular basis, either a quarterly or monthly basis with some updated forecasts. And then on a periodic basis, we're closing the books and consolidating our results to see how the organization is performing. And then there's certainly a set of reporting activities that happen to take a snapshot and report those results both to the internal management team as well as external stakeholders. And then following right alongside that is analytics, really starting to look at what happened and why it happened. How did we perform against the original budget or plan? How did we perform against the latest forecast? How did we perform this year versus last year, or comparing performance across divisions or product lines and so forth. And in that process, maybe I see some things that aren't going according to plan. You want to make some corrections going forward. And basically, we're back to the top of the cycle, to the modeling step. Maybe we're looking at some potential changes to pricing or shifting resources to different parts of the business to get it back on track and have a better chance of achieving our goals and objectives. That's the cycle that organizations go through to manage performance and help them to hit their goals and objectives. When this is done correctly, with the right tools and processes in place, it really can help organizations to increase efficiency by eliminating spreadsheets and improving planning and reporting processes. It can help drive accountability across the organization by getting the right information to managers and also empowering them as part of the planning process, having them take control and ownership of their own budgets and plans and forecasts, and then also providing managers with actionable insights they can use to make the right decisions on a day-to-day basis. So what's new in EPM? When we think about it, the core tenets of EPM really haven't changed in the past 10 years. What has changed is the environment that we are operating in. Here's some examples here. We have new and changing regulatory requirements, as we just discussed today, the new upcoming revenue recognition guidelines. More shorter term, there's new overtime rules that impact which employees are able to receive overtime pay and which aren't. There's also changes coming in lease accounting, so these things are always coming and need to be able to adapt and respond to them. Global competition, shorter product life cycles. There's a lot more volatility now in the marketplace than probably ever before, thinking about things like fuel and other commodity prices, changing exchange rates. Probably going to see interest rates changing here soon. There's more data to analyze than ever before, thinking about data coming from internal systems, websites, social media, other external sources. So that gives certainly a lot more opportunities there, but some more challenges to face in trying to take advantage of that data. We also have now a more tech-savvy workforce. with the millennials coming into the into finance and into management, right? They grew up using the internet and mobile devices and getting instantaneous access to information. Expect to see that, in the workplace as well, and aren't going to be happy if they don't have, great tools to work with. So, what are the impacts of this on the finance organization? A number of things. One is we see a lot of organizations, trying to eliminate spreadsheets and reduce manual processes to become more productive, shorten the close and planning processes and be able to respond quickly to new requirements. We are seeing many organizations putting less reliance on annual budgets and then more focus on dynamic planning techniques like rolling forecasts and driver-based planning. So well, there is a school of thought out there about getting beyond budgeting. I'd say 95% of the companies that I've worked with over the past few years are still doing an annual budget process. They seem to be putting less time and effort into that and trying to steer more of their resources towards those rolling forecasts on a quarterly or monthly basis, and that takes the pressure off the annual budget process. So we're seeing many organizations trying to improve their analytic capabilities so they can leverage these new data sources and also quickly model new scenarios so they can better predict future outcomes of decisions and the impacts of things like we spoke about today with the new revenue recognition guidelines. And then we also see many organizations trying to get better to respond quickly to new requirements from users and also embrace mobile technology to enable anytime, anywhere access to financial as well as operating results. So those are some things we're seeing in the marketplace and how they're impacting finance. So how are companies doing and responding to this? And here's some other recent research data from EPM partners on the state of the market. Some different data points than we saw with Ventana data and also what we saw in the survey today. This one might be a little biased towards users of EPM applications, but as you can see here, when asked about what tools were being used for EPM processes, that could include budgeting, planning, forecasting, reporting. We see a mix of on-premises applications at 30% here, cloud-based applications at 25%, and then spreadsheets still going strong here at 25%, and then you see ERP at 8%, and then other tools after that. So maybe a little higher percentage of companies using packaged applications in this survey and a bit lower on spreadsheets. But we are seeing, over time, I've seen spreadsheets usage as standalone solutions for EPM processes has been declining as more and more companies adopt packaged applications. But it certainly still exists as a front end to those packaged applications. In fact, there was another question in this particular survey was, are you still using spreadsheets to supplement your core systems? And 83% responded yes, that they continue to use spreadsheets to supplement their core system. And when they were asked, what they're using spreadsheets for as a front end, here's the kind of answers that were given in terms of usage models. You can see here, additional analysis was the most often cited reason. Almost 60% to just do some additional kind of front end, maybe some analysis and modeling and forecasting. Data input, an alternative data input mechanism is certainly a fair usage of spreadsheets. Handling complex calculations, again, modeling kind of offline in spreadsheets, 43%. These are all good uses of spreadsheets, and many vendors, including ourselves, support the spreadsheet as a front end to the EPM applications, and it really lets finance users continue to use their Excel skills while having a better solution on the back end to do the heavy lifting. So here's what that looks like from kind of an architectural standpoint. So here we can see Excel being used for what it's good at, for kind of personal productivity and as a user-friendly front end to EPM applications being used for data entry, maybe for reporting, analysis, maybe some charting and graphing as well as personal models. And then behind that is an EPM application providing a more secure and scalable back end, handling all the heavy lifting for things like budgeting, planning, forecasting, workforce planning, CapEx planning, all the things that we do in the planning process, as well as other EPM activities like the financial consolidation and close and reporting and modeling and so forth. And the EPM applications also are a better data collection point for data coming from other systems, right? So we're always taking feeds from financial systems, oftentimes human resources systems in terms of headcount and compensation information, CRM systems when it comes to sales forecasts, as well as data warehouses and spreadsheets and other sources. So again, this approach is a great way to transition users if you're currently using Excel as your primary system for planning, budgeting, and forecasting. Having the ability to use Excel as a front end to an EPM application can be a great transition strategy for the users, but you can still leverage their training expertise in Excel, but then have that more scalable back end handling the heavy lifting for that particular process. Back to the survey data, a few other additional points here to highlight. Question here is about how companies are feeling about their budgeting process, and here you can see the answers were 74% said it's too long, it's labor intensive, an equal amount saying it's labor intensive, 56% saying that it's not easy to administer, and you can see other concerns here, lack of workflow, visibility into calculations, data integrity, and also limited collaboration capabilities. So those are some of the challenges you certainly typically see with spreadsheets, and also sometimes with legacy applications. But the good news is that we're seeing this is gradually changing over time, and as organizations move to better solutions for budgeting, planning, and forecasting. And we are seeing increasing adoption of cloud-based EPM applications. In this particular survey, when asked about adoption of cloud-based EPM, 24% said they already have it, so they're already using cloud-based solutions. 35% said they're considering it. Another 6% said they're only looking at cloud-based applications. We're seeing that happening more and more often these days. And also, only 7% actually said that they're not considering cloud-based applications. So it is becoming a much more popular, and in some cases the primary way of deploying applications now. And we're seeing that in other surveys, hearing it from finance executives, and they're getting much more comfortable with the cloud-based applications as concerns about security and performance are really starting to subside. It's great to see. So in summary, some of the key points. Today's market certainly requires a more dynamic approach to planning, budgeting, and forecasting. Many organizations are still relying on spreadsheets, whether it's 25% or 65%. There's a lot of spreadsheets out there still in manual processes, and leading organizations are starting to move off of spreadsheets. They're adopting cloud-based EPM applications. They're putting less focus on the annual budget, as I mentioned, and really trying to put more of their effort into regular rolling forecasts that can really give you a head start. If you're already doing a rolling forecast that goes 12, 18 months into the future, you've already got a nice head start in terms of your next year's budget, and then the process becomes maybe a bit less rigorous to create the annual budget. And this ultimately leads to better business agility and competitiveness, and really an ability to respond more quickly and better and easily to new requirements like the new revenue recognition guidelines that we spoke about earlier. So with that, we'll go to another polling question before we shift to our customer case study.
Okay, great. Thank you, John. Let's take another minute here to launch our second polling question. And this one is asking, is your company going to be impacted by the new revenue recognition guidelines? And as before, it should pop up on a blue screen on your end with the answer choices listed below the question. So please take a minute to lob in your vote at this minute. As a reminder to all the attendees, if you are here for credit, please make sure you answer all 3 polling questions. As a reminder, this is the second of the 3. And we can also take questions for Q&A anytime throughout the webinar, so feel free to type those in under your question box in your control panel. And like before, I'll leave this question up for just another few seconds before we shut it down and take a look at these results here. So let's shut it down. So, John, it's a pretty wide mix of answers here. What are your comments on this here?
Looks like some of Rob's education certainly is helping. We saw that almost 30% are saying yes, they're definitely impacted by it. Another almost 40% are still researching it. So it's great to have people on the webinar today. That's why we do these things, to help educate the marketplace. And then we've got a number saying definitely not and probably not. So I think a lot of companies are still trying to get their heads around this and understand whether it impacts them or not, to what extent. So I'm glad that we're helping, and it's good to see that that progress.
Okay, great. Thanks for your thoughts. Let's get back to the slides.
Yeah, so we'll transition now to our customer case study. We'd like to welcome Derek Hazelwood, financial analyst at Interactive Intelligence. So Derek, thanks for joining us today.
Appreciate you having me.
Derek is part of the company's budgeting and reporting team. The team is responsible for managing global budgets across all departments for Interactive Intelligence, as well as all of the manager reporting as well. So let's go ahead and get started. Maybe just to start, Derek, can you just tell us a bit about Interactive Intelligence and what do you guys do?
Yeah, Interactive Intelligence is a global leader of cloud services for customer engagement, communications, and collaboration. And it's designed to help businesses worldwide improve their service, productivity, and reduce costs. And the company is headquartered in Indianapolis, Indiana, and we have more than 2,000 employees worldwide.
Excellent, excellent. Then can you talk about what your situation was like before you adopted a cloud-based budgeting and planning solution?
Yeah, just like a lot of folks on the line today, heavily Excel dependent, and so a lot of our processes were definitely longer and more mundane, and even accuracy an issue when you have so much manual intervention over Excel spreadsheets. So like a lot of the folks on the line, we depended pretty much 100% on spreadsheets.
Okay, so you've moved to a packaged application deployed in the cloud, and then which processes from a budgeting, planning, forecasting standpoint are you currently supporting with the application?
So we basically support most of the processes. We model out our revenue, our CapEx, our OpEx. And we also do our headcount planning within the software, and so it's become kind of an all-in-one solution for us.
Excellent, excellent. And then are the users mostly within finance, or are they also do you have line managers also using the software?
Yeah, we definitely have several users in finance. Our revenue teams and our cost accounting teams, but we also have a pretty wide adoption across our sales groups worldwide and our marketing groups worldwide. So it's been really great to have those folks online and in the system with us.
It's good to hear. Good to hear. Has there been much resistance or any training issues trying to get line of business managers to use a software system like this?
Yeah, I mean, I think there was some just natural resistance to a change in process, which we expected. But one of the great things about our solution is it's really easy to learn and to see what it is you have to do to get the proper inputs or do the proper approvals. And so we've had really minimal reliance on our IT group. And have actually, our team has done most of the training, and it's been really easy to get folks up and running in the system and understanding of what it is they need to provide and the approvals they may need to provide as well. So definitely one of the highlights of the system for us is the fact that we can do most of the training and management ourselves without relying on IT.
That's great. That's great. It's great to hear. How about before we go to the next set of questions, can you talk about revenue recognition and kind of how you guys have been approaching that so far, how it's impacted your planning and forecasting?
Yeah, so we're heavily contract-based in our revenue recognition, and as Robert spoke before, there's going to be a lot of work put into analyzing those contracts and for changes by the new revenue rules. Especially being a software company, we're going to see lots of changes, and so that will subsequently change the models that we're currently managing in our cloud planning solution. And so basically, we have three main tiers of product lines, and depending on which product line the customer is provided, the revenue recognition is different for all of those. And so we're able to model those in the system, and so with these new rules, our legal team and our accounting teams and our revenue teams can all collaborate together in the system when changes are necessary, and it helps us to analyze those contracts a lot easier because it's going to be kind of a painstaking process to look at all of those contracts essentially one by one to assess them for changes. And so having those consolidated in our system is going to make that a lot easier process, and a process that can be collaborative too. So it just kind of provides those efficiencies built in.
Great to hear. Are you doing any kind of grouping? I mentioned earlier, you talked about the need to get more granular in terms of planning and by contract level, or are you kind of group them together where they're common? Is that how you guys are approaching it?
Yeah, so there is definitely granular detail, but I think one of the biggest things that we're going to have to deal with, and Robert spoke about this before as well, which I feel is one of the more profound effects of these new rules, is helping management and leaders, decision makers, to understand those divergences between the accounting rules and the business rules. So the real revenue and real finance behind the GAAP standards and IFRS standards. So it's going to be, I think, increasingly important to provide that information to management so that they're able to understand, and being a public company, to help our investors understand what those differences are and what impact those may have on our financial statements.
Gotcha. Sounds good. Sounds like you were getting way ahead of the the requirements here, so that's good to see. Back to some of the questions on the screen here. In terms of data coming into the planning process, especially in support of RevRec, what kind of data sources are you integrating from?
So a lot of our data comes in via direct input from the source. Our cloud solution tool allows us to, allows the managers, whether it's a marketing field manager in Japan or a sales territory manager in the Netherlands, they're able to input a lot of the data themselves. And just like pretty much every company, there is some Excel spreadsheets that exist out there further down the line. But our solution allows us to easily integrate those utilizing data load rules based on those inputs to have an Excel file essentially marry up to the cloud solution in just a matter of a few seconds, getting it uploaded, and so and in a form that means something to us and that integrates with our planning process. So a little mixture of everything, but we're trying to go as much as we can to just direct input from the source of the information, and it's really helped to create natural efficiencies, allows us to be more agile, to track changes. Excel, I think, tends to be pretty flat and pretty static in the data. It's really hard to make agile changes to it, and so when you allow your users to have direct input, it gives you that ability to be more agile and track those changes, and then subsequently report on those changes when they occur.
Great. So we're kind of saying some of the benefits there in terms of agility and flexibility. Any other benefits you've seen from the solution so far in terms of either reducing process cycle time or accuracy of plans and forecasts?
Yeah, I mean, it's certainly reduced our planning time. It's allowed us to really achieve the benefit of a rolling forecast. Scenario management in our cloud solution tool allows us to create an unlimited number of scenarios based on assumptions that are provided us to us by the leaders of the company to kind of model out what if scenarios, and especially now we're entering our 2017 planning. This is really a time when we really need to be as agile as possible because leaders want to see a lot of different scenarios modeled out, and so using the scenario management, I think, really allows us to kind of just stay on track and stay organized, so that when we're changing inputs in those different scenarios, it's really easy to track. It's really easy to report on because you're able to kind of pivot on different scenarios, and so scenario management definitely a big efficiency gain for us. And then I would also say that the templates, the modeling template structure, to be able to build out templates and really easily broadcast those to all of our different budget entities around the world, because we have hundreds of budget entities. Be able to use those for all those entities really easily, and then realizing that you're probably using multi-tab Excel sheets. If you're not doing this, it's really helped us gain tons of efficiency with the templates.
That's great. That's great. Great to hear that. Any plans for the future? What's next for you guys?
Well, we're always looking for more automation, and so trying to create efficiencies in our planning process to kind of improve our rolling forecast ability to basically when an ad hoc request comes out that assumptions need to change and things like that, to remain agile and be able to churn out those reports to management. We're always looking for more automation. And I think that we have a great base to achieve that, because one, we've got, we have templates, we have scenario management, we have engagement across the entire organization, whether it's sales, marketing, IT. We have those folks in our system, engaged and ready to provide that information when it's needed. And so we're just always looking to automate more, and I think another big thing that we're looking to do is to improve our cash flow management reporting. So that's kind of our next frontier is improving our cash flow reporting capabilities.
Gotcha. That sounds good. I think automation, always the more you can automate, the more productive finance team becomes, and hopefully that shortens some of the processes and frees people up to do other more value-added activities like cash flow reporting. So I think you're on the right track.
Absolutely.
So hey, appreciate you joining us and sharing your insights today. I think with that, we're going to wrap up the case study and go back to Kwa for the Q&A session.
Thanks, John and Derek. A really great discussion there. As John has mentioned, let's just wrap up here and go into Q&A. We do have some time for just a quick question here. So, John, let me direct this one towards you. Previously, you mentioned that a lot of EPM users are using the EPM software and Excel at the same time, working both of them together. Is that the common scenario, or a lot of people actually just completely switching over to software?
Yeah, good question. I don't think we don't see Excel go away 100%. Typically, you certainly can again replace it as the primary way of aggregating budget or reporting data, and move that to an EPM application. Now the cloud's becoming the popular approach there. You could actually drop Excel completely. A lot of the solutions, including ours, actually has kind of Excel-like interface that's available through a web browser. So to the users, it looks like Excel, but it really is it's a browser-based software that has a lot of behaviors of Excel. So you could actually drop use of Excel completely, but I think you see many cases where Excel continues to be used, where data is being exported occasionally and then brought into Excel for some modeling and analysis. I don't know, Derek, you want to speak to how you guys currently use Excel alongside of a cloud-based solution?
Sure. I think that, it's tough to rid yourself of Excel completely, although I do agree. I think it's possible, especially with our solution being so Excel-like. It really provides a lot of the features that Excel, provides as far as data entry and formula entry and things like that. But what I think the predominant use of Excel for us is tracking inputs across the different budget entities, and using a data load rule functionality that essentially pre-maps those Excel files for us in the software, so that when we're provided the new inputs in those Excel files, we're able to load those into the system and put those exactly where we want them in our models and in our different templates. And so we're really minimizing the amount of manual intervention we have to do, because those Excel files are already pre-mapped, and it gives us data validation, so the system won't take it unless it's properly validated. So even though there is some Excel still out there, we're able to really automate how we consume those files and then subsequently input those into our different models and our different scenarios.
Okay,
I think
great.
that's really typical, right? Is using like Excel for data collection, from a template standpoint, but then again passing it over to a system that can more easily, aggregate the data.
Great. Thank you
exactly
for your
right.
thoughts. Thank you for your thoughts, both of you. And let's wrap up with a few final items here before we launch our last polling question for the attendees. First of all, thank you to all the speakers. So thank you, Rob, John, and Derek. Great to have you all on today's broadcast. And if you'd like to join the community for a conversation just like this one, feel free to visit proformative.com. And if you'd like an introduction to any of the speakers or the sponsor, please let us know on the post-event survey. We make it very easy to make that connection with just a few clicks of your mouse. And speaking of the sponsor, a big thank you to Host Analytics for supporting Proformative webinars. Couldn't do without them, so big thank you to them. And at this moment, I will launch our third and final polling question here. And as before, it's going to pop up on a blue screen. And this one is asking, what concerns do you have about cloud-based financial applications? Is it security, data integration, performance and scalability, or ease of use? Or, of course, no concerns. So please take a minute to log in your vote here. As a reminder, if you are here for credit, please make sure you answer all three questions. This is the final of the three that we have. And I'll go ahead and use these last few moments to thank all of our attendees for taking the time out of your day to learn with us here on Proformative. Great to see everybody at these events. And I'll go ahead and shout out the most popular answer here. It's 44% saying security. So it's very interesting to note. Definitely something I've seen before. And I'm going to leave this polling question up for another few seconds before we shut down the webinar. After the webinar shuts down, you'll be directed to our short post-event survey, which we certainly appreciate you taking. So once again, thank you for attending, everyone. Have a great rest of your day, and we hope to see you at future Proformative events. Thank you.